G'day there, Wealth Press viewers, subscribers, traders, and investors. Welcome to another weekly wrap up. And my guest is, of course, Roger Scott. Roger, how are you today?
I'm doing great, James. Thank you for having me on this wonderful Friday. And thank God
Yeah.
it's Friday.
Yes, TGIF, after quite the week, what a roller coaster. Saw Tesla give up almost 20% of its value after its split. Apple almost the same. What does this portend for us this week?
Well, I hate to say I told you so, but I have been, I've been talking about my momentum levels now for a month. And we've been seeing narrowing of momentum. The put to call ratio has been really signaling. And I'm gonna say something really interesting. It's kind of counter what your viewers probably want to hear to some degree, but when you're looking at a bullish market, it's much easier to make sense of fundamentals. When you're looking at a bear market or a market that's increasingly running the chance of becoming overheated, the technicals actually and the momentum, the internals, really give you a much clearer picture. Especially look at this. Look at what's happening right now. There wasn't anything to precipitate this. It just happened. Usually Wall Street. Now I love how Wall Street does. I love how Main Street does this. How the news medias do it. They love to give us explanations. They
Yeah.
they always have to have a rationale. Notice whenever market sells off, profit taking. Wall Street took profit taking. They never say loss taking. They say profit taking, right? Well, for every winner, there's a loser. You can't have it both ways, but it's always profit taking. They always like to rationalize after the fact why the market sold off. But honestly, there was no logic. There was no reason. There's nothing happened. Nothing. The Fed data was solid. Construction data was good. Unemployment data is as good as it was the last 3 weeks. Nothing really changed at all. But internals were telling us for 2 to 3 weeks that rubber band is stretched out. And it was just going like this and just going like this, just moving back and forth, but it was stretched out. The percentage of stock in the NASDAQ above, the number of stocks in the NASDAQ 100 trading above the 200-day moving average, the number of stocks in the NASDAQ 100 trading above the 50-day moving average, the way gold has been trending lately. The fact that the bond market has not been a driver of stocks, the fact that money's been moving back and forth between gold and the dollar and not really pushing the dollar one way or the other. All of these things have been giving us signs. Most importantly, the put to call ratio. It's been just going down and down and down and down and down and down, saying the market is just getting, the lower it goes, the more bullish the sentiment becomes. And it's like a rubber band, James. Let me give you and your viewers a little understanding of how this works, okay? So you have buyers buying calls and you have buyers buying puts, okay? When the number of calls being bought is overwhelmingly higher than the number of puts being bought, the market tends to revert. Similarly, when the number of puts being bought is much, much higher than the number of calls being bought, the market reverts. Now, the interesting thing about this indicator, 95% of the time, it's useless. It's the most useless indicator on earth because usually that rubber band is within its range. And it'll stick in that 80th percentile. But 20% of the time, that rubber band will stretch. And when that rubber band stretches, and it's a very short-term, very effective indicator. When that rubber band stretches, it has to pull back. And in the last few months, even when it pulls back, it's been pulling back very narrowly, and it's been really, really showing us that the calls have been overwhelmingly controlling this market, and that's just not a normal market cycle.
Interesting. So, again, you've been alluding to this pressure on the elasticity inherent in such data, and you've been making very clear the case that this moment was coming and this moment has now arrived. But I'm curious now, so is this like I kind of fall prey to the deer in headlights moment where it's like, okay, Tesla lost 18% of its value. Is it time to rush in and buy Tesla now after it's split? Because
Now,
now it's got this perceived lower price, which I know is going to catalyze greater retail interest just because the retail crowd is nominally driven in many respects.
it's interesting that you mentioned that. I've done some research specifically on this phenomena that you're talking about right now, and you're 100% correct. Statistically speaking, when stocks split, the equities over, I don't remember, don't quote me on the time period. I don't remember if it's 3 months or 6 months, but I know it's not 10 years. It's a relatively short amount of time. The stock rises on average of 8 to 12%, so about 10%. So this is not something that you're just pulling out of your, you know what, this is very, very statistically. No, over many years, this is very, very, I did a video about this, how Apple and Tesla should gain about 10% of their value. But our internal, I had a couple of our guys actually ask me, is Tesla a good buy about a week and a half ago? And I said, yes and no. It's a great buy because of what we just discussed, because it's statistically going to go up 10%, but it's a bad buy because of what I'm seeing the NASDAQ 100. And overall, it's doing exactly as I thought because it has such a high correlation to the NASDAQ 100. And again, the NASDAQ 100, this is the example I give my students in my room. You're watching a race car from the sideline, and the car is going 100 miles per hour around the track. And let's say it's a 8-cylinder, okay? Let's say it's a 350 Ford 350 engine, 8-cylinder engine, okay? And let's say those gaskets start breaking one at a time. But the engine, so the car driver has to press harder on the gas pedal to generate the same momentum to get 100 miles per hour out of that car. We don't know that sitting on the sideline. You and I are just observing the car and we're seeing it go 100 miles per hour. But if you were looking inside that engine, or if you were driving that car, you would feel it, you would hear it, and you would know it because you're now pressing harder. Well, we've been in that mode now for about 2 months. We had 95% out of 100 stocks, and this is an easy number to calculate because there's only 100 stocks in the NASDAQ 100. So we had 99% of stocks trading above the 50-day moving average. That number went to 68%. Meanwhile, price went up 15%. You see that? So we're not just driving 100 miles per hour, we're increasing our speed. We went from driving 100 miles per hour to driving 130 miles per hour, but we went from using all 8 cylinders to using about 5 cylinders. You see that? How long can that happen before it crashes? It's only a matter of time. And you can measure that with momentum levels. And this is as clear as day. I mean, this is down to, I could literally tell you down to a stock per day. It's easy calculation because there's only 100 stocks. So if it's 90, you know it's 90 stocks out of 100. If it's, it's a no-brainer. It's not like you have to do some magical calculations.
Sure.
So the point is these. So here's I wanted to kind of take a little route, but to answer your question, I think the market has to cool off some more. Typically, when you see momentum levels that high, they need to cool off all the way to the 30th, 20th percentile. We are right now, James, at 65th percentile. So we have substantially more to go. Also, the NASDAQ is breaking down today on positive Fed data. So to me, this looks like a very typical and a much needed cool off. This is the same thing as somebody running around the block for a mile. They need to pause. They need to rest. Otherwise, they can't go at it again. So right now, I'm not seeing anything scary. I'm not seeing anything that we need to really change what we do. But I hope people out there took my advice and went from stocks to ETFs a month ago, like I said, to give them that broader diversification, less exposure, and might have now reduced their positions. We've been talking about that. We've been very optimistic, but we've been very cautious. And this is what we're talking about. I don't think there's anything major happening right now because there's no major catalyst. But again, I talked about the COSDAQ.
Hmm.
The Kosdaq, the South Korean Kosdaq, it's been going down now for 20 days. And it hasn't started cooling off yet. So I'm watching global markets, I'm watching emerging markets, I'm watching the gold market and the bond market. The bond market right now is sitting right below the 50-day moving average. The S&P right now is sitting right above the 50-day moving average. And they're playing, it's like a game of mouse. Who's going to move first, you know? And if S&P dips, that bond market is going to go up. So folks, if you're in the equity markets, and if you want to take advantage, if you want to hedge your portfolio without liquidating it, ticker TMF or ticker TLT. One is a triple leveraged, one is a regular bond position. And if the S&P continues decelerating, you will see a spike in the TLT and or the TMF. And again, the TMF is just a triple leveraged version of the TLT, and that's the long bond. And whenever stocks fall, you will see a flight to quality, thus investors moving assets into the long bond.
Hmm. Wow. Okay. Those triple X ETFs uh, are reset daily, though, correct? And it's always a triple relative to the performance intraday, not over a broader period than that. Is that correct?
Well, actually, it's simpler than that. They don't even follow the bond. The triple digit just follows the single leveraged ETF. The single leveraged
Oh,
follows the TMF, and the triple follows TLT. So TLT follows the long bond, the futures,
I see.
and then the TMF, it just takes the TLT and triples it.
Okay.
So
That's
it's
it.
a derivative. The ETF is a derivative of the actual futures contract, and then the TMF is a derivative of the derivative, but
Boy, oh
not in an options form, but in a equity form.
boy. Hmm.
So
Okay.
for our programs, we use, sorry to interrupt you, for our programs, our leverage programs, we'll use the TMF for like the Titan, we'll use the TMF as a hedge.
Okay. Interesting. So, what about gold ETFs and
And
equity?
that actually brings me to my next subject. And I also like gold very much, ticker symbol GLD, or you can invest in one of the top gold companies. I prefer the GLD because it just gives me a very good even exposure, and it tracks the gold futures contract. And there's several double and triple leveraged and negative core. I mean, there's a bunch of these. And if you guys want to find the right ETF, you go to Google and type in global ETFs. It'll give you a website. It'll be one of the first two that'll have 70 or 80 global ETFs. Also, our members, for WealthPress members in our members area, we do a daily rank of every ETF available to the US exchange, and on a point system. And it's inside our VIP program for our members as well.
Wow, fantastic. Okay, so now what about gold miners? I mean, gold's a little bit beat up here too. This
Yeah.
is this is peculiar uh, situation where gold is actually mimicking the broader markets. That's kind of a, I mean, it has happened in the past, but it's not very common. And what does that portend?
Well, if you've noticed over the past few weeks, we've seen some upside in the US dollar.
Hmm.
And we've seen money moving from the US market into the gold market, which is in essence investors fluctuating between the US economy and global economy, US economy and global economy. So what I've been seeing is, because investors are still flooding US markets. Why? Well, they are still the most bullish markets, and US still has positive interest rates. So in essence, James, what you're seeing is you're seeing investors fear the US market and put the money in the US equity markets and fluctuate between the US dollar and the gold market depending on how they feel that day the US equity markets or the US stability will be. So right now, the flavor of the week is dollar, because US investors are seeing weakness in the equity market, so they're fluctuating into safe markets or safe haven markets, and the US dollar is part of that. It's mostly gold, US dollar, and bond market, and those three, and you will see money rotating from one to the other, depending on yield, quality, and what investors are feeling in terms of our safety nest.
Yeah, the 10-year is up right now 5.86%,
Yeah.
which is interesting because the gold futures are, where did it go? I was just looking at, oh, there it is. or down, well, down 0.5%. But so that's interesting, that correlation. So what is the perceived strength driving into the US dollar at this point then?
The fact that U.S. equity markets may be in danger, and typically when U.S. equity markets go south, investors tend to put their money into the U.S. dollar because it's more of a fixed asset.
Despite its absence of yield.
Right, right,
Hmm.
right. It's just, well, think of it's like the best of three choices, you know, and honestly, it's been kind of strange because you see, one of the biggest reasons why the U.S. dollar is not moving is because interest rates are so darn low. And the problem right now is we know interest rates are going to stay low for some time. So the question is the yield going to be coming into the U.S. dollar or the gold market? And I think the question there is how stable investors around the world are seeing the U.S. economy versus the rest of the world. And it's just a matter. I think investors right now, with the elections coming, are going to start pulling money out of the U.S. economy till after the election's over, or at least the U.S. stock market. Because U.S. stock market, typically during elections, during regular cycles, you will see money being taken out of the U.S. equity markets in the summer months. Okay.
Mhm.
In election years, you typically see money being taken out of U.S. equity markets during the fall, leading into the elections. If you look at the last election, the summer was very volatile, just like this summer. And then as soon as September hit, the markets just went dead. And then they picked up immediately after the election. And that happens every 4 to 8 years, because of the election cycle, because there's just so much uncertainty. And regardless of who wins, there's not going to be as much of a downside to the US dollar versus the US equity market. So I think investors right now are going to be pulling money out of the equity market and rotating them into the US dollar as well as gold.
Mhm.
But historically, the US equity market and the gold market have about 70% correlation,
Mhm.
which I thought was kind of interesting. So it's not that surprising, especially during a quick drop, to see investors getting spooked out of the US equity markets and fluctuating.
Sure.
But there's only so much the US dollar is going to do realistically with yield so low right now.
Sure. So should we be, as sort of shorter term traders, should we be either on the sidelines or looking for a short strategy into US equities?
Well, no, I don't think so. I don't think we're going to. I think the only time I would consider looking into short strategies for the U.S. equity market is if the S&P 500 went back below the 200-day moving average.
Okay.
Right now, I'm going to become. Here's how I would play the next few months. Okay, I would diversify away from individual stocks and more into ETFs. That's number one. Number two, I would adjust, instead of having 70 or 80% of my portfolio in equities, I would probably put about 30% and diversify between US dollar, gold, and interest rates. So only about 30% of my equity would be in the equity market, and only about 5 or 10% would be in the actual equities. The rest would be in ETFs. So till the election is over, I think we're going to see a bumpy road. I don't think we're going to heat up that hot. And even if we do, the US ETFs will catch that rise. And if the US equities continue rising, the gold market will continue rising. So I think this hedge will give us a nice little balance between risk and reward.
Sure. So what about the COVID stocks, which have been more or less selling off consistently alongside the rest of the market? Especially it's the one that really surprises me is Novavax, which, despite announcing a successful phase 1 trial, has seen its stock sell off now 20% from the day of that announcement. And this is a company that's moving and has demonstrated safety and a degree of efficacy in the vaccination, in the immune system response in their vaccine.
Well, let's be clear. If you look closely at stocks, there's three groups of stocks: phase 1, phase 2, phase 3. regardless of how good the phase one stocks right now is, when the whole this COVID thing started panicking in February, March, and April, and May, and all the investor and institutional money and retail money started moving into healthcare stocks, it was kind of like the internet in the early 90s. You know, it doesn't matter what you do. I mean, look at Time Warner and AOL. I mean, talk about the biggest disaster known to mankind in the equity market. I mean, talk about idiocy. But anyway, I digress. The point is that we had kind of like a Wild West for healthcare stocks. But the closer we got, the closer we're getting towards November, the official date when something is supposed to come out, the more reality strikes. And what investors did was they were like, COVID stock, let's put our money, let's throw our money in there. Let's blindly put our money in there. Also remember, a lot of ETFs, medical ETFs that were bought up have a bunch of different stocks. So these stocks were brought up, whether investors bought them directly or indirectly, they all kind of moved up because the entire sector was moving up. You couldn't do anything about it. But now investors are becoming more selective. Investors are asking questions. Is this a phase one stock? Is this a phase two stock? Is this a phase three stock? So, and the closer we get to you know, the drug being released, the less important the phase one stocks will look, and the more important phase three stocks will look. So I'm seeing investors put much more money into Merck, into Pfizer, into what is that? The last one, it starts with an A. The third company, it escapes me right now. Asta something, Asta. But there's three companies that are in phase three: Pfizer, Merck, and that's it. Yeah, that's the one.
Okay.
So I think if I was an investor and I was focused still on healthcare stocks, I would literally be focused on those three stocks. And I would be diversified between those three stocks because you don't know what's going to happen. Or maybe even put my money in an ETF, which is what I've been suggesting for the last month when the stock market just became really, really hot. I said, this may be a good time to become more defensive. And the way I become defensive is I take stocks, I wait till I have a profit on the stock position, then I'll move into the ETF, I'll see what happens, and then I'll move to cash. Because if something happens like yesterday, you will be much, much better off if you were an ETF versus an individual stock like Tesla or Amazon or many of the medical stocks. So I think that's happening, James, because it's kind of like the Darwinian effect is happening on these bio stocks. I think the cream of the crop is rising and the rest is just falling behind. And let's be honest, phase one is, did it do something to did it stimulate the immune system, and is it safe? It's a far cry. So I think investors, like, they want it now. They want to see what's available now. And I think over time, as these pills or these drugs come out, and as we start seeing issues developing, for example, side effects, doesn't work on everybody, cost issues, supply, I think we will develop more appreciation for the smaller bio stocks, but this is not the time for them right now.
That's interesting. The Canadian government actually made arrangements to acquire 100 million plus doses of Novavax's vaccine candidate, even at this stage, which I thought was quite funny. Leave it to Canada to, you know, try to be clever and jump the line, only to find themselves in the early stage.
You remember when, you may or may not remember when Prozac came out. Prozac was, you know, changed the world, SSRI, uptake inhibitors, a whole different class of antidepressants.
Yeah.
But meanwhile, over the next decade, you had drugs like Zoloft came out, Paxil, probably 3 or 4 other ones that I'm not making, and the companies made a lot of money with them, but not because of anything, that the fact that Pfizer had side effects, some people couldn't take them, some people had problems with it. There's always room for another drug, but not when this leader's coming out. It's kind of like the shiny object syndrome.
Right.
Darwinian effect is the best way to kind of describe it.
You bet. All right, Roger. Well, that's a fantastic conversation as usual. I really appreciate the discussion. I look forward to talking to you next week. Have a fantastic weekend.
Thank you for having me on, and have a great weekend, James. Bye, everyone.